Valuation multiples typically are on a range, a low, mid, and high end of the range. And so the question becomes, what places you on the low, mid, and high end of the range? Well, we're going to talk about the number one metric buyers will evaluate to determine if you are going to receive a premium multiple. We call it the golden metric, or net new assets. So let's talk about something that's fundamentally important to your valuation. And when we speak about valuations in other videos, we're giving you a basic mathematical formula to derive valuation, which is simply going to be a multiple of your EBITDA or net income. And we express the multiple that will be applied to EBITDA. We often quote a range, a low end of the range, a mid, and a high end of that range. And so it begs the question, what causes my EBITDA multiple to be on the low end versus the high end? And the reality is that there are several factors that go into this, but one of the clear drivers for sophisticated buyers, particularly those backed by private equity sponsors, is how much is this potential partner firm growing? And so we would just refer to that as your organic growth. We see a lot of firms who come to us and we ask them about their organic growth history. They'll be quick to point out of how quickly they're growing. And they're often quite proud of the fact they've been growing at a fast clip. Therefore, they'll tell us that their growth rate is not an issue. Unfortunately, a lot of what they are talking about when they're referencing their historic growth is total assets under management or revenue growth. For example, let's say they had $100 million in AUM at the beginning of the year. At the end of the year, they were at $130 million. So they would say they would grow by 30%. While that is technically correct, it's not how a buyer is going to look at your growth rate. The reason is that a part of that growth came from the stock market's performance. And the reality is that a financial services AUM or revenue growth rate is impacted by a large number of factors. For example, if of that $30 million in growth, 15 million of it came purely from the stock market performance, should that be evidence that you're a growing firm? Well, I can tell you, buyers don't think so, because it also hides other relevant facts, such as client terminations. Let's say in the same year, the one that I just mentioned, you lost $10 million of existing clients due to terminations, death, or whatever. Just saying you started at 100 million and ended at 130 million would obscure that fact. And that's a major data point that a buyer is going to want to discern when evaluating your growth. And so we would refer to that 30 million of growth as simply gross organic growth. A buyer is going to want to pierce that veil and understand, okay, if we remove the stock market's impact to the seller's historic growth, what's the real growth rate of that firm? And the term for this is net new assets, or NNA. And it's perhaps one of the most important metrics that buyers ask of us at Alaris. And so it's a metric that you really want to understand and try to calculate for yourself, because this will be the growth metric that the buyer is using when evaluating if you're actually growing or not. As I shared, it's not going to be just simply looking at your year-over-year assets and revenue growth. So let's take a look at the net new asset calculation and help you understand how it's applied. This will go a long way towards helping you understand how a buyer is going to evaluate your growth and then directly how it's going to impact your valuation. So let's start and look at a single year. Go back to my previous example and say that at the beginning of the year, your AUM or asset level was 100 million. And at the ending value was 130 million. So in your mind, you're thinking my growth rate was 30%, which would be fantastic. You started at $100 million in assets, you ended at 130 million, simple growth rate is 30%. But as I said, that's not how a buyer is going to evaluate that growth. So we're going to go through the same scenario I just discussed, that 30% growth scenario, and do the net new asset or NNA math and see how this compares to the 30% pure or gross growth rate that you calculated. We first are going to look at something called net inflows. Net inflows are monies that are coming into your practice, and it typically comes from two sources. It comes from new clients bringing new accounts to you, or deposits from existing clients. Let's say, starting with this 100 million of AUM, we had new client deposits of $10 million. Really simple. Next, we want to see how much in AUM came from existing client deposits. These are clients that are already at your firm. They're merely adding to their accounts with you. So let's say we had $5 million in existing client deposits. So between new clients of $10 million and existing deposits of $5 million, that would be a total of $15 million of net new assets or net inflows. Now that we understand the inflows, next we need to evaluate the outflows of the practice. The first thing that we want to do is we want to subtract distributions from our existing clients. So this would be simply clients that are taking withdrawals from their current balances. So in our current client base, let's say we had $7 million of outflows from clients withdrawing monies from their existing accounts. Next, we want to evaluate any client terminations you had in the same year. Let's say you lost $5 million of clients who simply left your practice for whatever reason. So your total outflows between clients withdrawing monies from their current accounts and clients who left the practice altogether would total $12 million. So the net new asset calculation would be new client deposits of $10 million, existing client deposits of $5 million would equal $15 million in total inflows, and we would subtract the outflows. So existing client withdrawals at minus $7 million, client terminations at minus $5 million would equal $12 million in total client outflows. So if we look at combining the net inflows and the net outflows, would simply equal our net flows. So the total net flows in this case would be $15 million of inflows minus $12 million of outflows for a total of $3 million of net positive flows. So $3 million in net positive flows, what's that growth rate? We would simply take the $3 million divided by the starting AUM balance of $100 million. That would equal a 3% net new asset or NNA growth rate. The rest of your organic growth in this scenario, therefore, 27% would have come from the stock market. In short, with a 30% growth rate and only 3% coming from net new flows, we would conclude that the stock market has totally buoyed your growth. So you can see how how they are evaluating your growth rate compared to how evaluating simply a gross organic growth metric. In many cases, the NNA calculation is going to produce a radically different number. In this scenario, showing a 30% growth rate from a gross perspective all the way down to a 3% growth rate from an NNA perspective. That's an enormous difference between the two calculations. In many instances, we actually see NNA being a negative number, even as the seller was convinced they had been growing at a healthy clip. So how does that impact your valuation? Well, the buyer would say this firm isn't really growing all that much, since their majority of their growth is coming from the stock market. Now, if this is you, when you're evaluating the EBITDA range applied to your business, you would not likely expect the buyer to be willing to pay a premium since you didn't have very much growth. From your general knowledge, I would say that anything north of a 5% NNA growth rate would be considered good. Anything north of 10% would likely be considered fantastic. So we hope this helps you understand how buyers evaluate your growth and how it impacts your valuation. I should also mention buyers will remove any advisory fees from this calculation since they're technically withdrawals that are really not outside of your control. They don't want you to get penalized for that. It's usually not a big number anyway. So that's the lesson on net new assets. It's a very important metric for you to understand and track, as it's definitely going to impact your valuation to a large degree. I'm Alan Darby, CEO of Alaris Acquisitions. I'm looking forward to meeting you soon.